All right, everyone. Well, as you know, my name is Jason Van Dyne, and I am the founder of Quest Wealth Strategies. And I know you get perspectives not only from me, but also from the other advisors one-on-one, but we still like to do this between 2 and 4 times a year, just to give you the perspective not only of ourselves, but of LPL as well. So what I'm going to do today is go through a couple of slides that talk about what's going on with the economy, how that might affect the stock market, even the bond market, and then uniquely LPL added this time, kind of how that's affecting geopolitics. It's a question we're getting more and more. I think with probably the conflict between Russia and Ukraine, as well as alternative investments and what's going on with those. So I hope to probably be done in 20 or 25 minutes, and then I'll just leave it open for questions. So if you've got questions, please do me a favor, jot them down. And then at the end, you could just kind of raise your hand and unmute yourself, and I'll call on you, and you can go ahead and ask them. Over time, depending on how many people pop in, we've had questions that last an hour, we've had questions that last 5 minutes. So with that, we'll kind of get started, and I can talk to anyone at the end that might have any questions. So the first thing that we're going to talk about is the economy, and just kind of what is going on with it. I don't know about you guys, but it's been to me this huge rebound that has made me very uncomfortable. It's not supported by as much as I would like it to from an earnings perspective, or from inflation or not inflation, interest rates coming down. So the economy is, like you said, kind of like a pendulum right now. It seems to be going back and forth between big drop in COVID, big stimulus, big drop last year, and now big increase again. So I think that the overall theme that we've been thinking about for about the last year and a half has really been inflation. Not because inflation is necessarily the most important driver in the economy, but the Fed's reaction to inflation, and when the Federal Reserve raises rates, how much it puts a damper on the economy. And then, of course, we'll talk a little bit later about how when they lower interest rates, it helps the economy, and kind of what investments perform well in those environments. As you can see there, the United States is growing only at about 1.2% GDP. It's positive, which is good. We're the biggest economy in the world. So, any positive rate of return is positive, and they're not going to be big numbers. I mean, I've seen articles that say it's almost impossible for the U.S. economy to grow much above 2.5%. We're just too big. It would be impossible unless we had a huge population increase. And what's nice is that we are above the Eurozone, as you can see there, and we are above the average of the advanced economies, which is really us, Europe, and Japan. Emerging markets look like they're having some great GDP growth so far this year. They're at almost 4%, which is actually really nice. That combined with a decreasing value of the dollar over time might really help boost the emerging markets. And globally is about 2.3%. What's great is, and why I think the U.S. is in a wonderful position compared to the rest of the world to succeed, is that look at our inflation. Our inflation last year hit 9.1%. We are already down to 3.8, which is great. The Federal Reserve wants us to be at around 2 is their target, which again would be wonderful to get it to that low. In the meantime, 3.8 is very much in the right direction compared to 9.1, and it's dropping all the time. About half of that gain of CPI right now is housing. Housing is still very expensive. There's not a lot of supply, and as a result of that, you're seeing a lot of people paying a lot for rent as well as their housing. But that's coming down a lot now. A lot of people sign leases in the summer. I think it has to do with when they get out of college, it's summer, and then they just continue in that path. And those lease prices are coming down a lot. I think in the next 2 or 3 months, that's going to really help reduce CPI even more. And then even more positively, we're significantly lower than most of the other places in the world. So the Eurozone is still around 5.5%. So they're really struggling to get their inflation down. The war in Europe has not helped them, from an energy perspective, right? That's keeping it pretty high. Even all advanced economies on average are still quite a bit above us. And emerging markets usually are. So them to be at 6.1 is not big news for them to be above us. But that's good that we're the lowest. So we've got some of the best GDP growth and some of the lowest inflation, as well as you can see, some of the lowest unemployment. Now that's both good and bad. It's probably good for us as citizens of the United States, but it's probably bad overall for the economy. 3.7% is really considered about zero. Actually, 3.5% unemployment is considered zero unemployment, right? That everyone who's looking for a job has one. Other people are just kind of moving in and out of jobs more slowly, but they'll eventually get one when they want. So the unemployment rate of 3.7 is a little bit above zero. We probably need that to get to 4.5 or 5% before we can really beat inflation. But we don't want it much more than that because that causes a recession. So the fact that the Eurozone is at 6.8, that's crazy high. That's if you could be at 6.8 and have inflation that's way higher than us, that's bad, because a lot of inflation is driven by unemployment going down. So the employees have more room to either switch jobs and ask for more money, or just go to their boss and ask for more money. It happens to me all the time in this inflationary environment. So if you have almost 7% unemployment, which is pretty high for the Eurozone, and you're still getting really high inflation, it means that the kind of the core or base inflation is really kind of out of control there. And the US doesn't really have that, which is nice. So inflation is the #1 story because of the Fed. And as the Federal Reserve stops, I mean, after the most recent raise they did, they say there's like a 10% chance of one more, and then no more raises. So we're near a pause, which is good. Small business hiring is slowing down. As you can see, it's going down and to the left. So that is a good sign. Most people are employed by small businesses. I mean, big businesses have huge numbers of employees, but there's just there's a million times more small businesses than big. So when small companies start to reduce their hiring, that will drive up the unemployment rate. And again, getting about 4.5 to 5 is good, because it'll ease inflation. Above 5 is bad, because that's probably going to be, like fueling a recession. With that, we talked about inflation and housing. I think this is really interesting. The single family units is in orange. You can see the orange has really dropped. So people are not building single family homes. They're too expensive. Interest rates are too high. People can't afford to buy them, and no one's building. So you can see that number has really plummeted. And it really, I mean, this graph goes all the way back to 1970. I mean, it's over 50 years old of data. And you can see that this kind of sharp downturn has only happened really like 3 other times in the last 50 some years. But what's unique is, if you see when the orange drops, usually the blue drops. In this case, blue is skyrocketing to record levels. Blue is multifamily, think apartments, condos, townhouses, big buildings, right, like skyscrapers. So they're building those like crazy. And the reason is rent is high. When rent is high, no one buys houses, right? Or no one builds houses, excuse me, because they're too expensive with the cost of materials and with interest rates. So everyone is building multifamily. As those houses, I mean, we're talking about, 1 million a year are coming onto the market at a fast pace. That is going to very much reduce rent, right? Because there'll be more supply. So that more supply for equal demand will mean lower rents. And rent is about half of inflation right now. So I think that increased multifamily leads to reduced rent leads to reduced inflation allows the Federal Reserve to lower interest rates. The Fed right now is between 5.25 and 5.5 is their target rate. An average rate in the last 40 years is 2.5%. So we'll talk about this a lot in the bond section, how the Federal Reserve could lower rates every time they get together next year and still not even be at their long-term average, which would make the economy boom, right? It would be wonderful. So multifamily units going on the rise is actually really good for inflation. I think I really like this slide, because some you'll notice I kind of blow through and others I take some time on. I really like this. What this shows is kind of how people spend their money. So look at from 2017 to 2020 here. You can see the blue is the services. So spending on stuff, someone to clean your house, going out to eat, riding on an airplane, getting a hotel room, those are all services. Goods are buying stuff, shoes, TVs, couch. So you can see that there's more spending, and it had been consistent for years, right? Way more spending on services than on goods. Then COVID happened and there were no services. You couldn't buy it even if you wanted to. So you can see how from in 2020, it spiked, right? The orange got a lot higher and the blue got a lot lower. So when the orange got higher, people started to buy more stuff. And that caused, I mean, it's fresh in my mind, at least I hope it's probably is with everyone else too, that really caused a lot of supply chain issues, because it sounds like a small difference going from 63% to 66%, but that's 5% more goods. Ports cannot handle 5% more goods. companies cannot make 5% more goods. Mines, and raw materials, right? Oil, cutting down trees for timber. You can't make enough raw materials for a 5% increase. A global 5% increase is crazy high. So, truckers, right? Everyone who wanted a job went to go be a trucker and made 100 grand for a year and a half. Well, right now, there's I've heard anywhere from 20 to 33% of truckers are going to be out of the industry by the end of the year, because it's going back to normal, right? You're seeing the goods, the share of goods is going down, and they believe it will continue to go down, and the share of services, from kind of that low point, is already past the goods again. That's why airfare is so expensive, hotels are so expensive. Embarrassingly enough, I went to the Taylor Swift concert with my daughter. A friend of mine called and he said, "Hey, I've got some tickets if you guys want to go." And it seemed, I didn't even really quite, I knew Taylor Swift was a singer, but I didn't really know anything about her. And you go to like this gigantic epic concert, but those tickets were thousands of dollars, which it baffles me. So these are services. So as people go back to services, now the service industry has shrunk, right? And now to get back to where it was before is leading to some inflation and to some problems. As that all evens out, as leases come down, as the share of spending on goods and services goes back to an equilibrium, which will be services higher than goods, it's all going to get back to normal, right? Which is going to create actually probably the same thing we had a couple of years ago, which is a worry about deflation, right? We worried about that for 10 years, right? Trying to offset deflation or make sure we didn't go into a deflationary economy. And we'll probably be back there. So people that say interest rates are going to be high for a long time, quite frankly, I think that's wrong. I don't think there's any data to support that really. And I think as inflation continues to come down again from 9.1, it's already 3.8. It's just got to go down to 2 for the Fed to be happy, right? Even trending towards 2, I think they'd be happy. And the goods, and so multifamily housing is going to come down. Is going up. It's going to cause inflation to go down. Rents will go down. People will get back to spending on services. The service sector will have to hire some people and build up that capacity and get back to normal. More flight routes and things like that. And goods, some of the goods people are going to lose their jobs, right? Because people are not going to be buying as many goods. And that will hopefully all kind of even out over the next year or so. And the economy will get back to what I would consider normal, where we're fighting the same challenges that we had more like 3 or 4 years ago, instead of the challenges of the last few years. So how does that all impact? That's great. That's a bunch of economic stuff. But how does that impact, us and your money and your equity gains? So here's some supportive stock market indicators. I don't love this slide, so I'll go through it kind of quickly. And it talks about the average gain or loss after, in certain instances. You'll see following a down year, the average market gain is 15%. That happens 84% of the time. The problem is that I see it is actually the stock market's probably a little too high because we're past that already, or we're quite a bit past that. The January trifecta years, the trifecta years, just read next to that what that is, so I won't waste time explaining it, which we had this year, was 17% return, which happened 90% of the time. Midterm election years, 90% of the time it went up. So what I don't like about the slide is the market usually goes up, right? 8 out of 10 years, the market will go up. So when all of these saying that's between 77 and 90% chance of going up, that's barely more than normal. So yes, there are some things like this that kind of support the stock market and where it's gone. But I think they're just based on historically what's happened, not actually what's happening today. And here we've got, I think this slide is very interesting, and it's changed a little bit of how we invest, which is that stocks no longer appear attractive relative to bonds. So there is something called a risk premium, right? So a risk premium is you divide, this gets a little bit in the weeds, so sorry for people that are a little bit more casual, but we won't get in the weeds a lot, I promise. But you look at the earnings yield for equities, which is earnings divided by the price, to the yields on bonds, which is just the interest rate, right? And you can come up with a factor. Well, that factor right now is about average, which is 0.9, meaning that there's not, if you're kind of below that average, if you're below the orange line, it means that stocks are too expensive. Look right here. I keep pointing at the screen. I know you can't see that. But look here, when did stocks get super expensive? Well, a lot, right? In 1999, right before a huge recession, stocks got expensive. The risk premium is way below that orange line, right? And then of course the market tanked after that. When were stocks cheap, right? Stocks were cheap in the 70s during deflation, or during stagflation, excuse me. Stocks were cheap. They were a good buy at the time, right? So right now, I think stocks were cheap a couple years ago, and specifically over to here was last October. But then look where we are now, because the market's up so much. So with interest rates being higher and and stock prices being much higher than they were, 20% over what they were just 8-9 months ago, that it might not make sense to be as heavily invested in the stock market, and it might make sense to switch back to bonds, because stocks are too expensive and bond interest rates are higher than they've been in 15 years. So I really think that's interesting, that LPL has actually come out and said that. And a lot of that's based on earnings. So most people don't really, this is the S&P 500 total earnings. I won't spend too much time here, but the S&P 500 total earnings per share is about 213 as an estimate. If it ends up being there, which we think is LPL believes is the most probable outcome, that's going to be a mild, short-lived recession, right? And I think based on the stock market being kind of a little bit high right now, and the Fed has probably raised rates 1 or 2 more times more than it should have, that I think that's going to cause the economy to drop a little bit. Now, I do believe that that's going to cause a little bit of unemployment, which is a good thing in this economy. And I think it's going to cause the Fed to lower rates, and it's going to be very short-lived, and we'll be right back to kind of a nicer, healthy economy. But I'm worried that today we don't have that healthy economy. Kind of the artificial inflation from COVID and all the stimulus everyone did was way too much. And we are just trying to get back to normal. And I think we're close to it, but I wish the stock market was 5% less than what it was today. And I feel much better. I think the earnings would support that. And I think it would be a healthier environment. And I'm hoping that health comes, maybe by the end of this year or the beginning of next, as we do have a little recession, the market drops, but then the Fed lowers rates and the market comes back up a little bit. That's healthier than I think what we've got today. Interestingly, earnings declines. So earnings are going down, right? Earnings declines don't always mean lower stock prices. So as you can see, the earnings, this quadrant here is the S&P 500 made money, but earnings were down. And that's where we are today. So even though that the S&P 500 is up a lot, companies are making less money, which makes no sense. But that does happen sometimes. So sometimes the market goes down too much, and so the earnings might come down 5%, but the stock market came down 30%. So the stock market rebounds even though earnings are lower. And I think that's maybe where we are today, because the market was probably way oversold in October. Everyone just got too scared of inflation and of the Ukrainian-Russia war. There's the 5 or 6 issues that people were really worried about, and I think it was too much of a sell-off. But I think that now this is probably where we are, is that the market can go up even while earnings are going down. I just think the market's up a little too far for where earnings are. Let's see. We'll go back to end of bear markets here. So the end of bear markets, once the market goes down 20% or more, what usually happens, the 3 months after that, 6 months and 12 months, you can see the rates of return there. The percentage of positive returns over that time frame. So you can see, but again, this to me is not very telling. If the market goes down 20%, it has a rebound, is basically what the slide says. What I take from this, which I think is obvious and I think is not valuable, but what I take from this is that even though the market is up 92% of the time and it averages 18.9, we're above that now by a fair amount. And that's why I think the stock market's probably a little bit overvalued. And when I say it's not healthy, that's what I mean, is that it's up, and it's probably up a little bit too much. And we are beyond all of these average rate of returns off of the bottom. If the Fed was lowering rates, not raising rates, I would feel much better about that. Bonds. So I think stock market's one thing, bonds is another. Still huge market. What this says is once the Fed is done, we could see a lot lower Treasury yields. So when the Fed does do a pause, the 2-year Treasury yields drop a lot. And 2-year Treasury yields, again, if you can think about it like a graph, the bottom part of the graph is time and the top is interest rates. Yield curves usually look like this, right? Where it's upward slanting to the right. So the longer that you go out in duration, the higher the interest rate is that you get. So the short-term rates, like the 2-year Treasury is pretty short-term. For that to drop these sorts of numbers when the Fed stops is a big drop. which is why we love like money markets and ultra short-term bonds and short-term bonds in today's marketplace. Because not only are they giving great dividends right now, but when the Fed does reduce it, they will get, remember, interest rates work inversely to bond prices. So if the Fed starts lowering rates, which we think they will next year, the beginning of next year, not only will you be making decent money on the dividends from all these things, but you could also get a pretty substantial pop in their actual bond value. So not only do you get dividends, but you get some capital appreciation. Back to the slide about equities, that's I think why LPL also thinks that the stock market's a little bit overvalued, and it might make sense to increase your exposure to bonds in this environment. 10-year treasuries, once the Fed is done, we could see lower treasury yields. I think that's probably true, but what's interesting is the 10-year yield doesn't go down. Look at the percentages here on the left-hand side. The 10-year yield is usually much higher than the 2-year. And this is how much it goes down. So what, an average of about 1%. But look at the 2-year yield, which is mostly much lower. It averages about 1.5% down. So the 2-year treasury is usually lower, but it drops more when the Fed stops. The 10-year treasury, which is usually higher, doesn't drop anywhere near as much when the Fed stops. And I think that's really important. People think like mortgage rates are going to come way down. Car loans, interest, student loans, credit cards are going to come way down. Well, all of that stuff follows the 10-year treasury. And you can see in a lot of cases, the 10-year treasury barely budges when the Fed makes a move. And I think this time is going to be very similar. I do not see, when the Fed lowers rates on that short term, you're going to see money markets go way down, right? You'll see short-term bonds go down, but the prices will pop. But as far as like the 10-year treasury, I mean, it's a little under 4% right now. I could see it maybe going to 3.5, like kind of in this range, like the 0.5% drop. But I'd be pretty surprised if it got down to 3. So I don't expect like mid to long-term bonds to really come up all that much when the Fed lowers their rates. It'll just be, interest rates will be higher, so they'll be making a nicer interest rate. But I don't see them getting this huge pop. Here, though, it does show how those bonds do after the Fed stops, because not only are they making money on the dividend like we talked about, or the interest rate, but they're also getting a pop of capital appreciation, like the actual physical bond is worth more if you sold it. And you get some pretty big numbers here. I mean, even in December of 18, the total return bonds for the year after a Fed pause are pretty big. I mean, in the next year, bonds made 9%. In December of 18, which wasn't that long ago. It's not like we're going back 50 years for that example. In 06, they went up 6%, but even in 2000, they went up 14. I don't like any of the examples before that. Interest rates in general were much higher back then, so I don't think it's as good of a comparison. But I think December of 18 is a pretty good comparison. So I would think maybe somewhere in between these two. So the Fed pauses, bonds could be in for a 7 or 8% year, I think, that year. Which, considering that they're much, much lower risk than the stock market, and the stock market's probably overvalued, again, that's where I think that bonds have some attractiveness now that they haven't really had since the crisis of 08, because interest rates have been so low, bonds have been terrible, right? So for the first time in my career, in 15 years, out of the 24 I've been doing this, I'm saying I like bonds and we should get some additional exposure there. Yields are up on cash. I think everyone knows that. For the people that are on this webinar, what I would simply say is if you've got money in your bank account and it's not making at least 4%, you need to move it to a money market. Money markets are not FDIC insured, but they're very, very conservative, or maybe even an ultra short-term bond fund. We had a talk with a company the other day that their ultra short-term bond fund's making over 5.5%, and they're very, very conservative. So again, short-term rates are high. If you've got some cash, get it to work. Bank standards, I think this kind of is supportive of a small recession. So bank lending is going down, and that's bad for the economy. So that is making a lot of smaller companies not be able to get money. The big ones always can, right? But a lot of the smaller to mid-sized companies that need debt financing, think big manufacturers that have to buy big machines, and even like one of our clients owns a clothing line, right? To get clothing, you have to submit all of your designs, and they have to get manufactured, they have to get sent here, and then they finally get sold, months later. That could take 6 months to a year to kind of go around. Well, that's funded with debt. If you can't get that money, you're out of business. So I think that this is bad for, the higher that the orange goes, the worse the lending gets, and kind of high yield hasn't really followed that. So we're a little bit down on high yield debt compared to like short and intermediate term bonds. because of the tightening bank standards are going to hurt those companies. They're kind of on the edge of being successful and making it. Again, the highs, I think interest rate highs are in. That doesn't probably surprise anyone. With that, we're going to go to commodities because it's 6:27, so I don't want to go too long here. But the foreign exchange, I hear a lot about the demise of the dollar. Clients bring that up a lot. And what this shows is that is true, right? The currency turnover, that dark blue there on the left, is the US dollar. And people are getting rid of the dollar faster than they're getting rid of other things. Why I don't personally think that's that big of a deal, and I'll go to the next slide for this, is there's still over 60% of all of the foreign reserves in the entire world are from the US. Right? The only other time it got way higher than that is it got into the 70s right after September 11th. Right, so it got really, really high. But a long-term historical average is probably more in the mid 60s. And right now, this is probably what, 59% or so, 58. I mean, it's not this huge, big change. And what I always ask everyone is, okay, so countries are getting out of the dollar. Do you know almost that whole change, though, is Russia and China? So Russia and China are holding less US dollars, and Russia's holding zero, and China's holding much less than they used to. And that's the vast majority of the difference. So I am not worried about the demise of the dollar. And what I always ask is if the dollar goes away, what else is there? You're going to bet on the Chinese economy. The Chinese are probably going to lose half their population in the next 75 years. Their economy is going to be worth zero, right? They are so fueled by real estate and debt. They are sunk. They're going to have so much trouble. They're going to be the world's biggest problem in the next 20 years, not the greatest opportunity like they've been since maybe the mid 90s. So, I mean, what are you going to replace it with? A Chinese currency that's going in the toilet that's controlled by a communist government? Are you going to base it on the euro, where countries are coming in and going out of it and always threatening to break away from it? I mean, the euro might not even exist in 15 years, right? Because of just the way that, because every country has control of their own interest rates, but then the currency is separated from that. It doesn't even make sense to have one big currency there. I hope that stays, but it might not. I'm going to go with the British pound. It's not even in the euro anymore, and their economy is this big on a world stage. The Japanese yen, right, which the economy hasn't grown in 45 years. I mean, so I just don't. I think the demise of the dollar is greatly overstated, and I think that it's going to be. I think that it's probably going to slightly go down over time. But it's going to be replaced with, if anything, with a basket of currencies, which is fine. If we're 60% of the basket, we're right where we're at now. So again, I think that is, I think that's been vastly overstated. On alternative investments, I'm going to go through this kind of quickly. I'll make sure you skip this one. So some people have been asking about alternative investments lately. Generally speaking, I don't love them. I think they're really, really great for like Morgan Stanley clients. If you've got more than 10 or $20 million, you should probably be in alternative investments. If you don't, there's not a great chance you should be in a bunch of alternative investments. They have a great, what they're really good at is they can provide a different covariance to the market, right? So if the stock market goes up, it might go up a little bit. If the stock market goes down, it goes down maybe a little or even stays the same, but it doesn't follow the market all the way down. That's what most alternatives try and do, is provide an alternative to the stock market. But it's difficult to find liquid ones. It's very difficult to find ones that are priced efficiently, where the cost is not through the roof. So again, we use them a little bit, but maybe now, because the stock market is so high, it's something that we might consider a little bit more in portfolios. But again, we just don't use them a ton, although people talk about them. So I thought including that makes sense. The last slide here is what the stack is LPL's research team. What do they like, right? They like international. International has been beat up a lot. And really the US currency, because we all live in the US, determines how well international is going to do. And they're way below, from a valuation perspective, where the US is. So they're way cheaper, which makes them very, very attractive at this point. Big companies, right? We love big companies because they're not going to have problem getting bank lending, where the small and mid companies might. But you see small and mid way over here on the left, because the tightening of bank standards is, and the fact that they're very expensive right now, they've come up a lot, is actually pretty negative for mid and small cap. Industrials, they like preferred securities, precious metals. again, kind of low beta alternatives. Again, I don't always love these, but in a stock market that's probably overvalued, they can make some sense. And mortgage-backed securities, because people are moving or refinancing, and all of the old 3% mortgages are going away, and they're getting new 7% mortgages. So the interest rates on mortgage-backed are actually increasing, where the interest rates, as the Fed puts rates down on everything else, may be decreasing. So with that, I have to go to a disclosure page. So disclosure. Geez, there's more of them than I thought. All right, so with that, I'll stick on this page. Well, we can go, I think I can make this little picture here bigger and see everyone in their hands. So before I say that, just let me say thank you so much for taking the time to be with us on our webinar. And if you have a question, there's that little box that says you kind of can raise your hand. So just raise your hand, in case